Felix here. Am I talking NVIDIA? Is this a $400 stock or is it too late to get in on the action? That's what we aim to answer here. And let me show you what we're going to run through. We're going to look at institutional ownerships. We're going to look at what the analysts are saying. We're going to look at the analysts' price targets. We're going to look at what happens after the earnings, which are up very shortly. And we're going to look at our unique Goat Academy quality score. We essentially score companies on a system, which I'll explain to you. So it gives you a score out of 100, whether or not this is a buy from my perspective. And also we're going to look at the discounted cash flow model with our price target calculated on our assumptions in our model here. All of this information, everything you'll see in this video, you can download. Just go to felixfriends.org/NVDA, and that's completely free. So take advantage of that. Much easier also to read along if you've got the file. So you'll find loads of stuff in here. I'm just clicking you through here. Also lots and lots of financial statements, which we're not going to look at. But if you are interested in NVIDIA, it might be a good idea to do so. So let's get cracking. As always, this is not financial advice. I must say that this is for entertainment only. Opinions are my own. Be smart and come up with your own valuations. And if you don't know how to do that, if you've never done a discounted cash flow model, well, I'll teach you that in about 15 minutes. And I will also give you all the templates and tools so you can build a very successful stock portfolio. So check out the Master Stocks course where I teach you that. Take advantage of the Build Wealth coupon, 29% off before the end of the week, because it'll change by the end of the week. So don't hang about. Now, let's get straight into it. Institutional ownership. We're going to run through this at a fairly good pace. So feel free to sort of stop and pause and always ask me questions if you like. So what can we see here? Well, we had a real spike last year of institutional ownership, and it sort of flattened off a bit, but it has been exceptionally consistent. You can always ignore the last little green bar here. So the green bars are the institutional ownership. Why can we ignore the last one? Because one way Wall Street essentially screws retail investors is by delaying the announcements of their trades. They do it somewhere between 45 and 90 days after they've traded. And this little chart down here would be September, and we simply haven't got the data in yet. So we are, therefore, I think, fair to assume that institutional ownership of NVIDIA is pretty stable at about 800 million shares, which is good. Inching up ever so slightly, but pretty stable. Now, this here, and let me zoom in a bit on this so you can see this better. This is what analysts make of it. So what do we have here? Well, we have 28 buy ratings. We have 7 strong buy ratings and not a great deal on the sell side. So that's incredibly positive from institutions. And what's our price target? Well, the average of these analysts is $227. The high one at $300, and 218 is obviously where we are as I'm recording this. So you're thinking, Felix, why did you put 400 on the thumbnail? Are you crazy? Is it clickbait? No, it's not. I will show it to you. I will get there. Just bear with me. If you're really truly impatient, you can jump forward to the end, but you will miss the why and the how. This is here earnings matrix, reported and estimated sales. So for 2021, we have 67% sales growth. This is the average forecast from analysts, including the bears and the bulls. And then for 2022, it's 54%. Now, one of the reasons price targets are not higher is that, look, in 2023, we're looking at 12%, 2024, 14%. Do analysts really believe growth is going to fall off like that? Probably not, but it's not uncommon for models to just build in some worst case scenarios down the road. They say basically visibility isn't that great beyond 2022, so let's go for a pretty safe number here. Let's go for 12%, which is, a fifth of the growth of this year, which seems, it would seem pretty harsh for them not to achieve that. Therefore, here with the ratings again, a little bit bigger and just a bit of a company profile if you don't know much about NVIDIA. Okay, NVIDIA, obviously, graphics card manufacturer originally. One of the big advantages they have is that all of the AI coders, all of the companies putting out AI software and applications prefer to code on GPUs, G standing for graphics, versus CPUs, central. CPUs is what, say, Intel produces. GPUs is what NVIDIA produces. And there is somehow some technicality in there that I don't fully understand that makes them much prefer it. It's just the better system for that. Now, I'll also show you here, if you want to gamble and trade on earnings, big word of caution on this one. These are the last 2, 4, 6, 8, 10 or so earnings dates, report days. And look at what the price change was. It was 1.7% up, 1.1% down, 5% down, nothing really up, 1% down, 0.6% up. So it moves very, very little on earnings. That's something to bear in mind. You're unlikely to get that massive rally straight after earnings. So you can make an options trade around that. You can build an options trade around that, say a straddle or a short strangle. And if that means nothing to you, again, I do have a free course on that, so you can check that out. Let me see if I can pull up the link here. Here it is, felixfriends.org/free options, where I teach you a lot of good stuff about options trading, because it's actually very low risk if you do it right. And if you're serious about options trading and you want to really understand how it works, just take the master options course. It's 100 lectures, all the strategies that actually work that you can apply. So jump on that. Again, same coupon, 29% off, build wealth to the end of the week. And you also get me and the beautiful community along with it. So you're not alone. You can always ask questions. You can always talk to me along the way. Now, why am I showing you this? Basically, earnings estimates keep getting upgraded as we go through this year. So analysts more bullish on NVIDIA over time. Similarly with revenue, we started the year with sort of 5 billion revenue estimate. Now we are at 6.6 or something like that. So it's moved up some 38% this year. So generally speaking, analysts very positive. Also, this is a lovely little chart here. Let me zoom in just a bit more for you. And what does it show? Well, the blue bars, the sort of dark blue bars, are the expected earnings each of the last bunch of quarters. Purple were the realized, the actual earnings. So you can see NVIDIA has a real history of beating earnings forecasts. Most companies aim to do this, but they're doing this particularly well. So bear that in mind, earnings are probably going to be good and the market will expect them to be good. Now, I'm not going to go into the whole moat argument here about NVIDIA. I do think they have a particularly strong moat on the AI side, to some extent also on the crypto side, and of course, many other retail applications. There is a link in here, a Forbes article, which summarizes this very nicely. It's a fairly long read, but if you're interested in NVIDIA, I would recommend it. It really just explains why NVIDIA is in such a strong market position. I'm going to summarize it as it's a good moat. It really is. And what does moat mean? It just means how hard it is for others to replace NVIDIA, essentially. Now, so we've run through quite a bit here. We will also look at the stock price chart here in a moment. But what we really want to look at here, and that's probably what you're gagging for, is what's this worth? Is it a buy, at least in my opinion, or our sort of GOAT Academy model? What's the GOAT Academy model? I'm going to just take you through this very briefly. My whole investment philosophy and also the philosophy of our academy is that we don't look for value stocks. We don't look for growth stocks. We look for really high quality stocks. Why do I make that distinction? Well, I'll show you in just a second. So we've got essentially 10 or 11 criteria here that we look at, and we apply a score to them, which you see here on the right, the maximum score range. So it's the key one, the heaviest one that we feature is ROCE, and that tells you basically the return to all stakeholders, so to shareholders and to bondholders. If you take the return, divide them by all of those people, that's your ROCE return, and it's a fantastic measure of essentially management effectiveness. We also look at operating margin, gross margin, which are good measures of cost control and essentially their ability to absorb shocks. We look at cash conversion. So how do you turn cash into more cash? How long does that take you? Free cash flow, which basically tells you what amount of sales end up as cash and so on. So there are a couple of more. We're going to run through them as we look at the actual numbers. And then moat is also an important one. Now, one of the things I ignore mostly is PE ratios. We will look at them, but we ignore them mostly. And I want to show you very briefly here an example why. If you had bought, say, Visa card in March 2012, you would have paid a multiple of 23x. And people thought that was crazily expensive at the time. If you'd simply held onto that and then waited for all those returns to kick in, your entry price multiple is now, your PE would now be 6 times. So over the time period, because you held a great company that was very profitable, that generated more profit growth than share price growth, actually, you got a really, really brilliant entry. So that's why I don't get too obsessed with multiples, because as long as it's a good company and as long as I hold it long enough, it doesn't really matter. So I can basically buy a good stock at the wrong price and it's fine. But if you buy a bad stock at any price, it's never fine. It always destroys value. And then also, why don't we look for value stocks? Well, because a lot of the time the value stocks destroy value faster than the stock price drops. Deutsche Bank, Exxon, GE, IBM, Shell, great examples here, which are just horrible investments and have been over many, many years. Whereas some of the more growthy stocks like Adobe, Amazon, Facebook have just done incredibly well. So again, if you bought Amazon in 2015 again, you would have paid a multiple of 593x negative because they were losing money at the time. And if you just held that, you would now own Amazon at a 7x valuation. So you would have done incredibly, incredibly well. So a little bit of background here. Do go through this more slowly if you like and ask me questions, and I will gladly answer them. So now here is our scoring. So these are, I've put at the top here, essentially, let me see if I can make this a little bit bigger. Yes, and I'll move myself down here behind the other Felix. Let me move the banner behind. You can still see the link if you want to download that. Literally everything you see on the screen you can download. I always want to share the information to make everybody smarter investors. So gross profit margin is the first thing we look at. We score that out of 5. So we give 5 points to this maximum. Is it the best gross profit margin in the sector? Not quite. Texas Instrument does slightly better, but other than that, they really are at the top of their game. So I would give that sort of a 9 out of 10, which converts into a 4.5 because we only give 5 maximum. Now, operating income margin, again, we give 5 points maximum here. So why do we look at this? Well, it essentially tells you a great deal about cost control. So it's really, really an important metric. And they have the second best in the industry here. So again, Texas Instrument being the only one out here. So I would again give that a 4.5. Always important to compare like for like. Like we could compare this to, say, Microsoft or something, and their numbers would look much better because they don't manufacture anything, which wouldn't be terribly fair on NVIDIA. Now, return on capital employed, this is really the big one. So it means that out of all of the capital they get, so that means all the money shareholders have given the company, all the money bondholders have given the money, they make 25.7% return on all of that money. And that's incredible and that's marvelous. And if you're a real estate investor, you know what that means. That would be the equivalent of getting 25% of your property value in rent a year. Almost impossible to achieve unless you're exceptionally leveraged. So this is not leverage, this is just what they're doing. So that's really, really very good. Now, we actually give this a score out of 20 because that's how important I think it is. It's very good, but AMD does 42%. Qualcomm does 40, Texas Instrument does 45. So we have to, even though it's fantastic, downgrade them a little bit on this. So I'm going to give them a 14 here out of 20 on this score. Now, cash conversion essentially means how much quickly do they, when they receive cash, when they receive $1, how quickly do they make another $1 out of that profit? They do it every 74 days. That's good, but it's not amazing. So out of 5, out of 10, I'd give them about a 7 for that. So I give them 3.5 here out of the 5 maximum that we give them. Now, the next one is similarly linked to cash and how they generate, what amount of cash they generate from all the sales they get, from all the revenue they get, how much cash they make out of that. 30% free cash flow margin. That's pretty good. And if you compare it to everybody else, again, Texas Instrument being the only one slightly better here. So I think that deserves essentially a 9 out of 10, which is a 4.5 on our score system because we can give a maximum of 5 points to that. Financial leverage. That is simply how much debt do you have compared to equity. They are not highly leveraged, which is very, very good to see. So for that, again, I give them a 4.5 just because it isn't the best number out there. You know, AMD does 1.5, so we could do slightly better, but I'm not worried about it. Interest coverage ratio, and there are only 4 more after this, and then we get to our final score, whether or not this is a buy. So interest coverage ratio basically means how many years can they pay their interest for if, revenue stopped right here. So they can do that 33 times over, so which is a very, very good, very solid number. Again, AMD does a little bit better, Texas Instruments too, and Intel also ever so slightly. But it's a good number, nothing wrong with that at all. So I'm going to give that 5, just because it doesn't really matter anymore once you're over sort of 20, 30 times your interest coverage. It's all good. You're just not worried about it. How about PE ratio? Is this cheap or expensive? And I said it's not relevant, but we still make it a small part of it. So it's about 5% of our whole model is the present PE ratio. They are by far the most expensive stock here, right? I mean, they are almost more double the price to triple the price to everything else in terms of that metric. So therefore, that gets a 1 out of 5. But here they have some room to catch up. I like to look at the predicted forward PE. So I want to see the change between today's PE, which is how expensive it is today, and what will happen in 2 years. Is this company growing so fast into profits, and are they generating so much money that the PE ratio will fall off very sharply? And yes, it does. So in 2 years' time, at the present valuation, the PE will be 35, which is much, much more appealing. And it's incredible that they can more than half that in 2 years. That deserves a big fat 5 out of 5. That's about as good as you can get. Then 2 more things. We look at consistency. So we want to see, is this a cyclical company? Do they have good times and bad times like airlines or shipping and things like that, which I dislike thoroughly? Or is this something that will perform for me again and again? Why do I dislike those? Because I can buy this if these numbers are good and forget about it. And I don't have to go and find another stock, which is what I love because it makes my life very easy. So their earnings per share trend, essentially, it means 75% of the time their earnings are increasing, which is fantastic. Qualcomm does slightly better. So this deserves, I'd say this deserves essentially 8 out of 10, 7.5 out of 10 if you wanted to be pedantic. Let's make it 8. So I normally just look here at the percentage figure and make that out of 10. Now, the long-term earnings growth rate here, that basically tells you exactly what it says on the tin. How are their profits growing in the long run? And we're looking at 32.8% earnings growth. That's pretty incredible, actually. Very hard for a business that's this size, this established, to have that level of growth. AMD, interestingly, does almost exactly the same here. So both very interesting businesses to look at. So that's a 10 out of 10 for me. And then we look at the moat. And the moat, you could say it's in a sense summed up in all of this. If you have a good moat, you have good ratios for everything we were just looking at. But there is a factor when you read a bit more about a stock, when you dig a little bit deeper into the industry and you understand more about what's their advantage here. And say, in my view, Intel is a few years behind. Could a new competitor come in and build a chip factory and do it better? Not really. I've talked to people in the chip industry and they're saying it would take at least 3 to 5 years to get a new chip up into development, by which point NVIDIA will be 3 to 5 years ahead of you again. So it's a hard game to catch up on, and therefore with that and their AI application and their application into cryptos, and it just being the chip of basically every major EV manufacturer as well, which is an incredibly process intensive use, I think they have on pretty much the perfect moat here, because in addition they have a very, very great brand as well on the retail side. So that takes us to a 10 on that. And what's our score therefore? Our score therefore is a very, very respectable 74.5. Now this is out of 100. So you could say, but Felix, I love NVIDIA. I think it should be 100. Almost nothing is. Almost nothing is perfect. There is usually always something that isn't quite right. So this is, of course, always a simplification, but I look at what I think are the key here 11 metrics, and we come up with these scores. For me, a 74, 75 is a buy. It's a buy in a hold pretty much forever situation. It's actually very, very hard to get these scores and very hard to get much higher scores. So that's where we are. So it says, from my point of view, it's a buy. I'm not telling you to buy it. Bear that in mind. do your own research, at the very least, go through my data and also check that the data is correct. I think it is, but you got to be responsible for your own decisions in life, and therefore you need to learn how to do these things yourself. Otherwise, you're always running blind, essentially. So this is a discounted cash flow model. Now, it says down here in my file, 10-year DCF. It says it also here at the top, people always confuse and say, so you think in 10 years NVIDIA is worth this? No, that's not how it works. What we do, and this is exactly what banks do. When I used to work in an investment bank, this is what analysts do. You forecast and model the next 10 years of revenue and earnings, and then you work back that value to today's discounted value. And that's exactly what I've done. So what's the major metric in here? Well, growth is really the major metric in here because that also drives our revenue, our profits. So for next year, I just simply went with Analysts average 54.7% growth rate. And then the year after, I'm not going with 10 or 12% because I just think their business isn't going to fall off a cliff like that. So instead, what I'm doing is I'm softening it out. So I'm doing 40% the next year, 30%, 30%, 30%, because I think we will sort of stabilize. And then I'm going down to 25, 20, 18, 16, 14. That's how I end up in 2031. Because the bigger you get, the harder it is to grow at high rates. And similarly with EBITDA margins, so essentially profit margins, I have them falling off just a little bit and sort of sticking around the 35 to 37%. And by doing that, I end up with a fair value of essentially $400, $399.39. That's the middle of my range. It could be higher, it could be 432, it could be 368, but that's my fair value. Is that my fair value today? No, that's about 12 months out. And that's, of course, a massive upside. That's essentially, nearly 100% upside. And it's a bullish statement, but I think go back to in my valuation model here, when I was showing you, a good stock, say an Adobe. If you'd bought Adobe in 2015, you would have bought it at 136x multiple, which is incredibly expensive, right? Profit multiple. If you held it since then, you would have about a 7x multiple. So good stocks, good profitable stocks. And by that, I mean particularly those with amazing ROCE, return on capital employed. They will just generate a lot of money because look, they're borrowing all that money. Say that, they have some debt, and their equity. And so they're borrowing that at a couple of percentage points and they are creating 25 percentage points return on that. So how can the stock not go up? That's the way I look at it. Now, there's no guarantees in life. That's sadly not how it works. But from my point of view, I'm very bullish on this. I do think it's a good stock. I've also put in here income statements, balance sheet, cash flow statements if you want to dig a bit deeper and you're not satisfied with all the digging I've done. And then lastly, let's look at the stock chart here. So this is essentially the stock chart going back to 2020. And I've put in this green path here. That's the direction I see this going in. Stocks with these kind of ROC numbers, in my experience, just perform very, very well. We are not at the cheapest price point ever. We were at a very good point in early October. We touched the blue 100-day moving average line here. That was a great entry point. At the moment, we are above the middle part of our channel here. So not the cheapest entry point. Generally speaking, when I buy stocks, I don't buy them all in one go. I sort of average into them over time in case I get the timing wrong, though what I've just showed you, if you buy a great stock, you can actually afford to get the timing and the price wrong as long as you wait and hold long enough. Now, lots of the stuff is shared with our lovely Discord community. You can get there through the Patreon, which if you click on it, it's 50 cents a day to join. And you can chat with me, you can chat with the community. It's really a really fundamental research-based community. Hang on, look, there was one $5 one available. That rarely happens. Otherwise, it's 15 usually is. They're usually sold out. So check that out. Take advantage of that. It's a beautiful community. And if you want to learn more about how to really build a good, solid portfolio without much learning, but mostly just with application, if you just want to get a templates and copy and paste successful strategies, well, Master Stocks course is the way to go. And if you want to make money out of your portfolio, and by that I mean income rather than long-term capital appreciation, options are the way to do it. Don't trade stocks. It's a terrible thing to do. It's much, much lower risk and higher return doing it with options. So dip your toe into that. All courses, as always, are risk-free. If you don't like it, you can return them. You get your money back. I think you get tremendous value over there. I'd love to see you inside the courses, and then you can chat with me every day. You can email with me. You can chat with me on the Discord or any other methods. And I truly appreciate you watching. Thank you very much. And I look forward to seeing you on the next video.